It often sounds unbelievable. How can wealthy business owners seem to pay little or even zero tax while still making millions? The truth is, it's not about illegal tricks or hidden loopholes, but about how the tax system is designed for businesses versus individuals. The rich don't just earn money, they structure it. Through deductions, reinvestments, business expenses, holding companies, and strategic income planning, they legally reduce what counts as taxable income. Meanwhile, most people only see the surface and assume it's unfair or impossible. We'll break down exactly how the rich use business structures to minimize taxes legally, and why understanding this system changes everything about how wealth really works. Today we will talk about how the rich use business to pay zero tax legally. So before we start, make sure to hit the like button and subscribe to my channel. 1. The difference between income and taxable income. Most people assume taxes are fixed and unavoidable, but the wealthy operate on a different understanding. The key difference lies between earning income and reporting taxable income. Ordinary employees are taxed at the point of earning through salary systems. Business owners, however, earn through structures that allow expense offsetting. Revenue is not what gets taxed. Profit is what gets taxed. This distinction is where most tax strategy begins. The rich focus heavily on reducing taxable profit, not necessarily reducing revenue. They achieve this through legitimate deductions tied to business activity. Expenses like operations, travel, staff, and tools reduce taxable income legally. This means higher business activity can sometimes result in lower taxable profit. The system is not about avoiding income, but structuring it differently. 2. Business expenses as a tax shield. One of the most powerful tools used by the wealthy is business expense deduction. Every legitimate business expense reduces taxable income. This includes office costs, salaries, software, marketing, and operations. Unlike personal spending, business spending can be written off legally. This creates a natural tax reduction mechanism. The rich structure their lifestyle around business usage wherever possible. Even travel and communication costs are often classified as business expenses. This is not loophole exploitation, but legal classification. The more structured the business, the more deductions become available. Proper documentation is essential for these deductions to be valid. Accountants play a critical role in maintaining compliance. 3. Reinvestment strategy and tax deferral. Wealthy individuals often reinvest profits back into their businesses. This reduces immediate taxable income while growing long-term value. Reinvestment includes equipment, hiring, marketing, and expansion. These expenses are deductible under business tax laws. As a result, taxable profit can be significantly reduced. This does not eliminate tax, but defers it strategically. Tax deferral allows capital to grow before taxation occurs. The rich prioritize growth over immediate extraction of income. This creates compounding effects within the business structure. Instead of withdrawing profits, they recycle them into expansion. This keeps taxable income lower in the short term. 4. Holding companies and legal structuring. Another key strategy used by wealthy individuals is business structuring. They often operate through multiple entities rather than a single business. Holding companies are used to separate ownership from operations. This allows better control over income flow and taxation. Different entities may handle income, expenses, and investments separately. This structure creates flexibility in managing taxable profits. It also helps protect assets from operational risk. Legal structures vary depending on jurisdiction and business type. Accountants and legal advisors design these frameworks carefully. The goal is compliance combined with optimization. Income can be distributed strategically across entities. This reduces overall tax exposure legally. 5. Salary versus dividend strategy. Wealthy business owners rarely take all income as salary. Instead, they balance salary with dividends or distributions. Salary income is typically taxed at higher rates. Dividends often have different tax treatment depending on jurisdiction. This creates opportunities for optimized income structuring. By controlling how money is withdrawn, taxes can be managed legally. The rich often keep salaries moderate for operational needs. The rest of earnings remain within the business or investment structure. This reduces immediate taxable income exposure. It also allows capital to be reinvested efficiently. Dividends are typically issued based on strategic timing. 6. Tax credits and incentive systems. Another major way the wealthy reduce taxes legally is through structured tax credits. Governments often provide incentives for job creation, innovation, and investment. These incentives are designed to encourage business activity in specific areas. Wealthy business owners strategically align their operations to qualify for them. This can include hiring credits, research and development credits, and investment incentives. Unlike deductions, tax credits directly reduce the amount of tax owed. This makes them extremely powerful in reducing overall tax burden. Many entrepreneurs overlook these programs due to lack of awareness. Large businesses often have dedicated teams to optimize tax credits. They track eligible activities throughout the financial year. Proper documentation is required to claim these benefits successfully. 7. International structuring and jurisdiction planning. Wealthy individuals often operate across multiple jurisdictions legally. Different countries have different tax rates and business rules. By structuring operations globally, tax exposure can be optimized. This does not mean illegal evasion, but legal jurisdiction planning. Income may be generated in one region and managed in another. Holding companies are sometimes registered in favorable tax environments. However, compliance with international laws remains essential. Proper reporting ensures legality across all jurisdictions involved. The goal is efficiency, not concealment. Global structuring allows better control over financial flows. It also helps manage currency and regulatory differences. 8. Asset ownership versus personal income. The wealthy often prioritize owning assets through businesses rather than taking personal income. Assets such as real estate, equity, and intellectual property are held within structures. This allows value to grow without immediate tax realization. Taxes are often triggered when income is distributed personally. By keeping assets within business entities, taxation can be delayed. This is known as deferral-based wealth building. It allows capital to compound before taxation occurs. Many assets also generate deductible expenses within business structures. This further reduces taxable profit over time. Ownership is structured for efficiency, not personal visibility. The goal is to separate lifestyle from taxable events. 9. Misunderstanding of zero tax claims. The idea that rich people pay zero tax is often misunderstood. In reality, most use legal structures to reduce taxable income significantly. They still pay taxes, but strategically and at optimized levels. Losses, deductions, credits, and reinvestments reduce taxable amounts. Media often oversimplifies this into misleading narratives. The tax code itself allows for these mechanisms. Wealthy individuals simply use existing rules more effectively. It is not about escaping taxes, but managing liability. In many cases, taxes are deferred rather than eliminated. Future events like sales or distributions may trigger taxation later. Therefore, zero tax is rarely literal in practice. It usually refers to low reported taxable income in a given year. 10. The real lesson behind wealth tax strategy. The true lesson is not about avoiding taxes, but understanding structure. Wealthy individuals focus on systems, timing, and financial architecture. They do not rely on a single income source or simple salary models. Instead, they use layered strategies to optimize outcomes. Tax efficiency is a result of business design, not shortcuts. Every financial decision is evaluated for long-term impact. Poor structure leads to higher tax burden regardless of income level. Strong structure allows flexibility and reinvestment opportunities. The difference lies in knowledge and planning, not secrecy. Legal tax optimization is available to anyone with proper guidance. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.